Hi everyone, good morning. My name is Deepak Bisht, and this is part three of merger and acquisition series, the advanced questions which we were discussing. So let's continue question number 14 onwards. Question number 14 is about the earnouts and why would a buyer offer it to a seller in a merger and acquisition deal? So let me just give you a quick brief first. So, what actually is a earnout? So, a earnout is a deal structure used in merger and acquisitions majorly, where the buyer doesn't pay the full purchase price upfront, and instead, the part of the payment is conditional on the acquired business meeting specific performance targets after the deal closes. So, basically, it means that if the performance targets meet, then there the business which is being acquired. So it's actually a condition. It's a part of condition on the acquired businesses. Uh, if the meet if they meet their performance targets only, then only the deal closes. So that's an earnout. So it's basically we will pay you more later if the company performs as well as you say it will. And these are the factors like revenue growth, EBITDA, net income, and customer retention after the acquisition. So if these things, if these targets perform well, then the buyer actually pays more to the target company. That's an earnout. So why a buyer uses an earnout? Because buyers often include earnout. They actually include earnouts in the contract because there is an uncertainty about the future performances. Like for startups or fast-growing companies where projections are optimistic, and to bridge the valuation gaps also. If the seller believes the business is worth more than the buyer does, the earnout says, if your projections are right, you will get the higher price you want, and also to align incentives and to reduce risk. So, aligning an incentive means to motivate the seller to work hard post acquisition, and it reduces risk in a way that the buyer doesn't overpay upfront for performance that might never materialize. So, it also reduces risk for the buyer. Uh, why a seller agrees to earn out? If we try to understand this from a seller's perspective, so from a seller's perspective, there's a potential for higher total payout. And along with that, it also shows confidence that, I mean, if a seller accepts an earnout signals that the seller believes in the company's future. And also it keeps control and engagement, especially if they remain in the business post sale. So, however, earnouts carry risk if targets are not met, so the seller might not receive the full amount. So there is a risk also. But it actually shows confidence that the sellers are actually showing confidence that their company will perform better. And whatsoever was their forecasted numbers, those will actually pay it off. In an example, if you think about an example, think from a startup's perspective. So let's assume that a startup is making 16 millions of revenue, and a seller receives 5 million earnout. So this means that the total sale price will be $20 million, but only if the company performs well. Um, mm, And in summary, if you think about it, so from a buyer's perspective, there's a benefit that it protects against overpaying and it aligns with incentives. And there's a risk from a buyer's perspective that it's complex to manage and disputes over accounting also happens. And from a seller's perspective, there is a benefit that the potential for higher payout, there's a potential for higher payout and it shows confidence, but the risk is that might not get full amount if the target misses. So that's earnout. And that's pretty much it. if okay, we will do a question. We do have an example. Let me just show you an example. Give me a moment. I'm going to share my screen with you. Okay, so if you can look at my screen, there's this example where the buyer, Tech Corp, and an hypothetical seller, startup, a small software company. So there is a burnout for, no, not a burnout, but there is a earnout. There's a earnout for the seller wants $20 million, buyer wants to pay $15 million. So they agreed that the $15 million upfront and 5 million earnout payable over 2 years if startup hits revenue target. So year one, they hit a revenue target 2 million extra. If they will earn a 2 million extra if the revenue exceeds $10 million, and they will receive a 3 million extra if the revenue exceeds $15 million. So for the first year, what happened is, so startup actually earned a revenue of $16 million, and seller receives the full 5 million earnout. The total sale is $20 million. So after 2 years, this means scenario one is the company performs well. So if they meet their target, so startup hits $16 million revenue in 2 years. So I'm assuming that for the year one, they will hit, uh, they will get 2 millions, and for year two, they will receive $3 million. So they will receive $5 million earnouts in total, and the total sale price will be $20 million. And if the company underperforms, so this means that the revenue reaches only $12 million for year two. This means that seller will receive only $2 million of the earnout. For now, if they are not able to meet the year two targets, they will not receive the full earnout. And this way, this is also an clause which is very common in merger and acquisitions. So, and it's very practical also. I hope this is clear. So let's move to question number 14, 15. So for question number 15 is about accretion and dilution model and how it's different from a private seller. So let me just give you a brief one more time that accretion is when accretion dilution, we have discussed it, though I would want to still give you a brief. So when a company buys another company, so the investor wants that. So what the investor wants to know is that will the deal make the buyer's shareholder better off or worse off? And whensoever it's a fiduciary duty, uh, as a board of directors or as a C-suite member, so you are at the top level management, so it's your responsibility to serve your shareholders, and you actually have to do whatsoever is in the best interest of the shareholders. So the question is, will this deal make the buy shareholders better or worse? So in public company, this is usually measured using earning per shares, basically how much profit each share earns. So if EPS goes up after acquisition, the deal is accretive, and if the EPS goes down, the deal is dilutive, which is bad for shareholders because of the share per share value actually decreases, and if the per share value increases, it's an accretive deal. It's good for shareholders. So dilutive means just remember this, that you are diluting something, you are reducing the impact. So like you are adding some water into something, juice or some soup. So you are actually diluting it. You are reducing the effect of the soup. So that's diluted. So an accretion and dilution model basically compares the buyer's EPS before and after the deal. And when the seller is private. Now, if the seller is private, a few things changes because private companies are different from the public ones, and the things which change basically are the deal structure. The deal structure is usually different. Private companies don't have EPS. Even if the buyer is private, accretion dilution do not really apply here in a public private company. And see, from a deal structure perspective, private companies' deals are often structured differently from public ones. So, public companies are usually bought by purchasing their shares, but private companies, on the other hand, are often bought through asset purchases, where the buyer actually buys specific assets like equipment or intellectual properties or customer list, and not the entire company. Understand this thing. So, you might get a okay, let's leave it now. Let's leave it for now because it will be way too much confusing for you people. So let's just focus on the public and the private company. So, so buyer actually do not, for a private company, the buyer actually buys the specific assets there. So those assets could be equipment, intellectual properties, customers list, and not the entire company. So if they acquire any of these, they actually acquire a private company. And that's most valuable for those companies. The list of customers also. And there is also a special US tax rule called 388H10 election, which allows the buyer to treat a stock purchase like an asset purchase for a tax purposes. And what does it happen? What does it actually affects is that the taxes, it actually affects the taxes and the amortization. So in financial models, you would adjust how taxes and amortizations are calculated for a private company. And private companies also do not have EPS. So public companies report earning per share because they have shares traded on the stock market. And private companies do not, I mean, they are owned by individuals or small groups, not public investors. So when modeling the seller's financial, you would stop at net income, not EPS. So you will not calculate the EPS because earning per shares, you cannot calculate earnings per share unless you know the number of shares. And because public companies have investors, so that's relevant. But for private companies, and EPS is not relevant. That's what the diagram is saying. So this means that the accretion and dilution model focuses on the buyer CPS because that's what matter to the buyer shareholders. And if the buyer is private again, so accretion dilution doesn't apply because both companies are private and there is no EPS to calculate. So accretion dilution doesn't make sense in a private to private acquisition. So if a public company is acquiring a private company, that makes sense. So one company will have EPS. Private company will not have EPS. Private company will look into net income. But if a private company is acquiring a private company, so accretion dilution will not apply here. So instead, you will evaluate the deal based on how it affects the overall profits. So synergies we discussed about and cash flows or the return on investment. So in a private to private acquisition, those are the factors which we will look into. So buyer is a private because there is no EPS metric. So think about it. If a company is private to private, they will majorly focus on how it affects the overall net income of the companies now after merger or acquisition, how it will affect the overall net income of both the companies or the cash flows or the return on investment. So if we are investing that much or if we are spending that much on the another company, so how would it if affect our uh, return on investment? So how much are we generating out of it? I hope this was clear. So, if just to summarize that EPS has an impact on public seller, not on a private seller. And uh, for a public seller, deal types are usually stocks, and for a private seller, deal types are often asset purchases or 388H10. 388H10 helps the buyer and the seller to help the seller and buyers with their taxes and amortizations. And third is that public companies majorly focus on EPS, private companies focus on buyer's EPS. And if the other company is also private, the buyer is also private. So for a public company, it will be relevant, but for a private company, EPS will not be relevant. I hope this was clear. So let's move to next question. Question number 16. The question number 16 is about how would I calculate the break-even synergies in a merger and acquisition deal, and what does the number mean? Okay, so synergies, we have read about synergies. So synergies is when a company buys another company. So they often expect to save money or make money once two businesses are combined. So these benefits are called synergies. There are two main types, cost synergies and revenue synergies. So cost synergies are saving from cutting or overlapping expenses, and revenue synergies are actually extra income from combining products or customers or sales channels. If I were to give an example, I'd say that let's assume that a company buys another company and they both have separate accounting teams, but they could merge them into one team or HR or others, SG&As, other expenses. So that will be an example of cost synergy. And what does break-even synergy mean then? So break-even means break-even synergies tells you how much synergy the deal needs just to avoid hurting the buyer's earning. So how much savings or extra revenue? So the break even. So it's so in other words, it's a point where the buyer's earning EPS after the deal are the same as they were before the deal. So either it's accretive or dilutive. So initially, there is a dilution impact on most of the mergers, but when does the synergies break even? I mean, when does they stop hurting? So the buyer doesn't make any, so buyer doesn't make more money yet, but at least the deal doesn't reduce profits per share. So that's what basically it means. If you were to calculate it conceptually, so what you can do is you can build a model showing that what happens to the buyer CPS after acquisition. And if the deal goes up, it's a, if the EPS goes down, so it's a dilutive. And then you estimate how much energy is needed to bring the EPS back to zero. And that's the break even point. So basically, you are solving for how much savings or extra revenue do we need. So the deal doesn't make our shareholders lose any money, basic in simple terms. So at what point would we start making profit? So initially there is an expense, and we are going to lose some money. Our numbers are going to be I mean, the metrics. EPS is a metric which is used to measure uh, profit or not. We are in profits or not. So, but initially, because see, the denominator, if in EPS, when we're calculating EPS, so the basic calculation is we divided by number of shares. So we divide the EPS by number of shares. Okay, it's not writing. So we divide the EPS by number of shares. So mm, we divide the net income by EPS number of shares. So think about it. Uh, the net income increases but not in proportion as the number of shares. Because the other company, once you are acquiring the other company, you are also acquiring the number of shares also. So number of shares actually add up. So denominator, if the denominator is bigger than the net income in a proportion, talking about in a proportionate term. So the EPS will be dilutive. And how much time it would take for the synergies to kick in or to show us result, expected result. That's the break even synergies. At what point we are at an no profit no gain kind of a situation. So that's the break even point, and after that break even point we start making profits, and the deal is accretive in future years. So that's the break even point. So if the break-even synergies are small, that's good. It means that the deal is already strong, and only little improvement is needed to make it accretive. And if the deal break-even synergies are very large, so that's risky, and it means that the deal only makes sense as the companies achieve huge cost cuts or big revenue gains, which might be unrealistic. So the numbers help decision makers judge whether the deal is financially sensible or too optimistic. And in sentence, break-even synergies show how much saving or extra income a buyer needs to make an acquisition worth it, where earning per share stay the same as before the deal. So if the before the deal, the earning per share was like $1. After acquisition, it has fallen to 90 cents. So how much time it will take and how much extra income the buyer needs to make post acquisition to bring it back to the previous level. So I hope this was clear again. Let's move to question number 17. And if you feel any question that you are not getting it, you can always post in the comment section. Don't be shy. I will be happy to answer any of your questions. Okay, let's move to question number 17 now. So question number 17 is about accretion dilution again. So normally in an accretion and dilution model, you care most about combining both companies' income statement. But let's say I want to combine all three financial statements, and how would I do this? Okay, so first of all, accretion and dilution, one company buys another company. If the earning per share is the metric. If the EPS is uh, if it makes the investors richer, it's a accretive deal. If it makes the investors poor, it's a dilutive deal. I mean, if the EPS is down, it's a dilutive deal, and if the EPS is up, it's a accretive deal. Uh, and that's why most of the accretion and dilution models basically focus on income statements, and that's where the EPS is calculated actually. But what if you want to, if you want the full picture? So if you want to understand how the entire business changes, not just the profits, you will combine all three financial statements for both the companies. Income statement actually shows profit. Balance sheet shows what the company owes and owns. So assets and liabilities basically, and equity. Cash flow statement actually shows where the cash is coming in and where it is going. So this gives you a complete and realistic view of what the new combined company will look like after the deal. And if we combine all three financial statements step by step, so what we will do is we will start with the income statement first. So we will add together revenues, we will add together expenses and the profits of both companies. Then the main thing is that we will actually have to adjust for synergies, whether it's cost saving or extra income from merging. New interest expenses will also be created because if the buyer borrowed money to finance the deal, leverage buyout, if there is a lost interest income, if the buyer used its own cash to pay, so there is going to be If I have a buyer, if I'm using my cash, so there will be a lost interest income and there will be amortization, spreading out the cost of things like patents or goodwill. So just understand this thing. So I am sure that as of now you understand there is going to be synergies, but interest, always focus on interest also. So there is no going to be an interest expense if there was debt involved, and there is going to be a loss on interest income. You have lost your interest income if you have used way too much cash from your balance sheet. To understand this thing, then that need to be adjusted in the income statement. Synergies, is there as an impact of synergies and interest. And then the third thing is the amortization. So amortization of all the patents and goodwills will be because it after an acquisition, all those things will be valued at a fair market value, and then in the term amortization. So remember this thing. Don't get confusion. Don't forget whatsoever we have learned as of now. Always apply those concepts here also. So this gives you the combined net income. So this will give you the combined net income. And after that, we will move to balance sheet. So after income statement, we will move to balance sheet. And here also just remember synergies, foregone interest income, new interest expenses from the deal financing, and any amortization of intangibles now. And when we combine the balance sheet, we combine the company's assets with their assets and liabilities with the company's liabilities. So we add the buyers and the seller's balance sheet together, but we need to remove the seller's shareholders' equity, because once the company is bought, all the old shareholders have no stake. Uh, why? The question is because if you remember, the shareholders have the last. Uh, I mean, uh, if the company is getting dissolved, the shareholders have the last claim to the earnings. So that's why they are writing it off. Then we make the adjustments for things that happen because of the deal. Like we subtract the cash used to buy for the sell buy. I mean, we subtract the cash used to buy the seller. We add any new debt or the shares issued. We create goodwill, and we adjust assets value if they were written up to fair market value. And here, so you will get why we have made changes in income statement, and these three are linked. That's why. See, such as cash used. If cash is used, so there is a foregone on interest income. If new debt is created, so there is new interest expense. If equity is issued, okay, new debt and equity is issued, so this means there is a new interest expense. Write-ups and creation of goodwill. So if there is a write-up or intangible asset, then there is amortization charges and creation of goodwill. Because this will be created if the deal was a premium or the buyer pays over the seller's book value. So goodwill will be created. If a goodwill is not created, so this means that the deal was, I mean, the company was sold for cheap to the buyer. So the goodwill will not be created. Understand this thing and don't forget any of these things. All right. So after these things, what we will do is we will adjust and project. So uh, project it into the future using standard assumptions, and assets like inventory and receivables grow as sales grow, and debt is repaid gradually or capped as a target ratio, and profits from income statements flow into retained earnings of the equity. Uh, so this is the, I mean, this is forecasting and other things, but it this is also done. We are talking about the combining. How do we combine? So combining is important because we have taken debt accretion and dilution. In the accretion and dilution model, we will look into the future also. So at what time accretion and dilution, previously we just discussed what, at what time the synergies will break even, and here in accretion and dilution, after how much time will the deal will start giving us, after, I mean, initially the deal might be dilutive, but after the break even synergies, the deal will be start to give us a better EPS, so it will be accretive after what year? And to build the cash flow statement, we need to start with the income statement of the income. Net income of the income statement. We add back the non-cash expenses, depreciation and amortization, which we have included here. Uh, so yes, and the changes in working capital. Uh, if you sell more, you might to need, I mean, you might need more inventory if you want to sell more. So changes in working capital also. And we include the cash used or raised from the deal also here in this cash flow statement. So paying cash to buy the seller is a cash outflow, and borrowing money to issue shares is actually a cash inflow. So finally, make sure that the cash at the end of the model matches with the combined balance sheet. So cash should match with the balance sheet, and all the expenses are all the expenses and incomes are taken into consideration. And this we have discussed in the introductory video, episode 000. And in simple terms, we are actually, when we are doing this all, so we are basically merging two companies' financial picture, profits, assets, debts, and cash into one single new company. And those steps will be here as discussed in the answer. So step will be income statement, balance sheet, and then go to cash flow. But previously, when we were discussing verbal questions on depreciation and amortization, we were first doing the income statement, cash flow, and balance sheet. But in these kind of questions, just use your intuition. Income statement, then balance sheet, and then cash flow. So that because income statement and balance sheet are used to make cash flow statements. So basically, you forecast cash flow statement based on income statement and balance sheet. Mm. So income statement is the third step. Uh, and I think this is clear. Let's move to next question. Question number 18. So question number 18 is about how do you handle options, convertible debt, and other diluted securities in a merger and acquisition model? So how do you handle all these things? So what's going on in here? So when a company buys another, it does not just buys the shares you see on paper. It also has a deal with the other financial instruments. It also actually have to deal with other financial instruments with the which can turn into shares later, such as the stock options. Uh, Stock options are actually employees' right to buy company stocks at a set price. So convertible debts are loans that can turn into shares if certain conditions are met. And warrants are similar to options usually held by investors. So options mean warrants. Warrants and options are almost similar. So these are called actually dilutive securities because when they are converted into shares, they increase the number of shares, which dilutes each existing shareholder's ownership percentage. So in a merger, the buyer needs to decide what to do with these. And two main possibilities at closing are that either they are cashed out or they are assumed by the buyer. The buyer keeps them active and replaces them with equivalent options or options or convertibles in the new company, or the buyer actually cashes them out. So buyer, what does the buyer do is the buyer pays the shareholders, sorry, the holders cash for the value of their options or convertibles, and they disappear. So uh, why does this matter? when these securities convert into shares, actually, so they increase the total share count. And since the buyer pays based on how many shares exist, the purchase price changes depending on how many shares are outstanding. So that's why outstanding and actual shares is important. So analysts need to figure So analysts actually need to figure out if all these options and convertibles are exercised, how many total shares would there be, and how much does the buyer have to pay for them. And in a when a company reports their financial statements, in the first few pages, you will find that the number of shares outstanding is given there. So step by step, let's discuss it. So how each type is handled. So options and warrants. If the exercise price is lower than the buyer's offer price, the option is in the money and it's available. So it's assumed that it's exercised before the deal. When we talk about convertible debt or convertible preferred stock, so these are loans or preferred shares that can turn into common stock if profitable to do so. So we assume it converts into shares. And if the conversion price is above the offer price, so it's out of the money actually. So it stays as a debt. So the buyer just pays off the loan balance. So convertible debt in the money and out of the money. In the money means that if I have a contract, so I have a convertible debt. Let's assume I have a $1 million. I am a debt. I have given debt to a company. I am a bank, so I have $1 million of debt given to company XYZ. And in return, they have given me that I can buy $1 million of shares for $2 each using that debt. So think about it. If using $1 million of debt, I can purchase share worth $2 in future if the company is making profit. If the conditions are met, so if the company's stock is worth like $5 in the market, so it makes sense for me to buy something which is worth $5 in the market, so I can buy it for $2. So I can buy it cheap by $3, but that's in the money. But if the company share are trading at $1, so it doesn't make sense for me to buy it for $2 because I can buy that $2 share in for $1 from the market itself. So that's in the money and out of the money, and that's the main thing convertible debt has. So convertible debt means that see $1 million. If I have given $1 million of debt to a company XYZ, so this means that ten if at a rate of 10%, so the every year the company will be paying me the interest payment of 100,000 and some portion of my principal also, or it depends whether what kind of the payment structure the loan has. So $1 million, ten $100,000 will be given to me by the company every year in interest payments, but the company is risky. So that's why convertible debt is raised because as a loan provider, I should also have an up a share in the upside if the company do well. So if the company doesn't do well, I do not have any problem. I will be getting my interest only. But if the company does perform considerably well, so I would also want to have uh, a share in the profit. So that's why convertible debt or convertible preferred stocks are raised. Convertible debt or convertible preferred stocks are raised actually. Understand this thing and Uh, so convertible debt, mezzanine debt, these things we will discuss. But see, if a company has a very complex debt structure, and the more the company has debt, so in future stages, the company is not able to secure any normal debt. So they actually have to go to convertible, or a startup actually have to go to whensoever a company is risky, either they are going towards bankruptcy, or either it's a startup. So they actually have convertible debt in their capital structure also. So pay attention to these details, pay attention to these names. What means you should know as a finance professional, or if you have an interest in finance, because finance is a very vast uh, very vast field. And in finance you cannot say that I will go and quickly update myself. You actually have to stay updated with the market, because by the time you update yourself, market changes. So you need to be updated every now and then. You need to update yourself constantly. And okay, so let's move back to the topic. So big picture is that all the analysts help the buyers figure out how many total number of share exist after conversion or exercise, and how much total money they are really paying for all those shares, and who owns what percentage of the new combined company. So in summary, options and warrants are actually in if they are in the money, they are assumed exercised, and if they are out of the money, we are ignoring them. So buyer does what in this case is buyer actually pays for extra shares. So we are assuming that in future these options or warrant are going to be exercised. If they're in the money, we are assuming that they will be exercised. So somebody will use those and they will exercise them. So number of shares will increase and we will pay extra money. If it's out of the money, means it cannot be exercised. Like $2 or $5 example. If the stock price is one, so it is out of the money and we do not need to worry about those. But even though it's out of the money, we will pay extra money. Whether if somebody wants to redeem their options or warrants, we will pay extra for extra shares as a buyer. So we will pay for all the outstanding shares. Uh, if the convertible debt is preferred, or if there is convertible debt or preference shares, so we will assume converted to shares if it's in the money. So if it's profitable for whosoever is holding those debt, we'll assume that it's paid. It's actually in the money, and we will assume that these are converted to shares. If it's out of the money, we will say that okay, if it's out of the money, we will convertible the convertible debt. We What we will do is we will pay the convertible debt, so that we do not need to worry about any convertible debt. And in this case, what the buyer does is actually they adjust total shares and the deal value. I hope this was clear to you guys. So, how do you handle options, convertible debt, and other diluted securities in merger model? So, this is how we do that. So, in the money and out of the money, we have revisited it one more time. If if it's profitable for the buyer, if it's profitable for the seller, so if it's in the money, it's profitable for the option holder. So option holder will exercise it in the situation of merger and acquisition, because they are not certain what the new acquirer will do with these securities. So what they will try to do is, if it's in the money, they will acquire it. So they will do it. They will exercise it. About the debt, so convertible debt, if we know that this is debt, this can be converted into number of shares in future. So what we do is simply we will pay off the debt, and we do not have to worry about convertible debt anymore. And that's pretty much it. And other diluted securities also, the treatment is somewhat around the same. So if they are in the money, we will we will assume that they are exercised, and we will adjust our purchase price and ownership split, and we will update our valuation. All right. So question number 18, till question number 18 we are done. There are few more questions left in the reading. And because these are advanced question of merger and acquisition, I'm taking only few questions in one session. So for better understanding and so that we do not skip anything. And all right, so thank you for today's session, and I'll see you in the next session. All the very best learning and keep updating yourself. All the best. Bye.